Okay, let's start with our second paper, which is Pricing of Climate Risk Insurance, Regulatory Frictions and Cross-Subsidies, going to be presented by Anna Maria Tenekedjieva from the Federal Reserve Board.
Thank you so much, Shan, and thank you all for attending the talk. Just before we start, this is joint work with Ishita from HBS, and the usual disclaimer applies, so all views expressed are my own. So let me start briefly by talking about what is homeowner insurance, why does it matter, and why do Ishita and I call it climate risk insurance. So basically, homeowner insurance is a financial product which homeowners can purchase to protect themselves against certain insured events. There's two types of insured events very broadly. We have climate losses, which is hurricanes, windstorm, wildfires, and in short, everything which is not the flood insurance which we just saw, which is federally owned, at least in America. And then we also have liabilities, which is vandalism, theft, etc. Costs were the ones whose distribution was a little bit uncertain. There was a lot of worry about it. Over the last two decades, with increasing climate change and climate change related disasters, climate losses definitely started dominating, the insured events in terms of losses. And as of now, purchasing a homeowner insurance is one of the major ways through which households can choose to protect themselves against climate risk. As a result, homeowner insurance is the second largest and fastest growing line of business in property and casualty insurance, and its written premium recently exceeded 100 billion. We can also think of it almost as a mandatory product, because in order in the United States to get a mortgage loan from bank, the household needs to prove that it has homeowner insurance with certain level of coverage. Also, homeowner insurance constitutes a large chunk of what we consider household expenses. On this graph, we basically try to compare how much, for a standard house, people pay for homeowner insurance compared to how much they pay for mortgage interest expenses. Basically, in the average state, the homeowner insurance is approximately 58% of what the interest expense on mortgage will be. But you can see that in the most expensive states, people pay even, in some cases, even more for their homeowner insurance than what they pay on their mortgage interest expense. So this is a significant chunk of basically their expenses. Another peculiarity about the way homeowner insurance work in America is that there are basically state-level rate controls. The rate setting is subject to stringent and binding state-level regulation in many states, and that can be a problem for insurers. With climate risk insurers, we see more and more climate disasters whose both frequency and severity has been increasing. As a result, the expected loss distribution is evolving and for the most part unknown. From the insurance perspective, this may require frequent rate revisions so that the prices reflect the true expected losses. But if we had rate regulation, it can make it potentially hard for insurers to set the rates they wish to. All of this can have potential consequences both for the insurers' climate risk exposures, but also for the way they choose to price and supply climate risk insurance. And through that, it can affect household finances as well. For the most part, this question has been understudied, and this is where we would like to focus our attention. Basically, we'd like to know what are the implications of regulatory frictions on the pricing and market structure of the US homeowner insurance market. Basically, there are two empirical challenges when it comes to rate setting frictions that we believe we can make some progress on. The first has to do with the measurement of regulatory frictions in the insurance market. Basically, the existing studies, when they look into insurance rate setting frictions, they take the rules as they are on paper and use that as a proxy for how strict the state is. However, this may not reflect the true extent of the frictions, since it can be a little bit ambiguous also in terms of what else comes into how the rules are on paper. We move past this challenge by constructing a new measure which looks at how the rules are being applied in practice. So how do we do that? Basically, we observe most rate filings made to individual states, and we can see what insurers state is their target rate change, so what they wish will happen, and what regulators actually approve. Based on this wedge, we construct a new measure of rate setting frictions. We notice a large heterogeneity when it comes to how strict various states are. The second point on which we believe we can make progress on has to do with identification. So usually in rate setting friction papers, when we have one firm which is regulated by one regulator. So it is hard to do within firm comparisons. However, the current setting allows us to move past this challenge, since we have a single firm which operates in multiple states. This way, each firm's price setting is regulated by multiple regulators, which allows us to study how the same firm responds to pricing behavior in different states, and also how does a firm respond in state A to what a regulator does in state B. So before I proceed with our analysis, let me briefly preview our findings. First, we find that the frictions in rate setting are binding and quite large, especially true in high friction states. Interestingly, we find that these high friction states tend to be the ones who are the most exposed to climate losses. Second, we find that in order for firms to deal with the frictions, they engage in cross-subsidization. Basically, they subsidize their business in high friction states with their business in low friction states by increasing the prices in the low friction states. In the last part of our paper, we basically try to see what are the consequences of the frictions and the cross-subsidization. So the cross-subsidization, basically, we have suggestive evidence that it leads to long-run decoupling of prices and risk. Over time, rates grow much faster in states with low pricing friction, despite these low pricing friction states having lower climate risk exposure. And the frictions binding naturally also can create problems for insurance availability. We do find that insurers exit high friction states. However, this is a relatively less frequent phenomenon and mostly concentrated among smaller insurers. However, it does seem like it affects customers, since we do see that over time, there is a faster growth in residual insurance markets. This last finding is preliminary, so we apologize to Shan, but basically residual markets are where a household that cannot find normal insurance goes as a last resort insurer, and those tend to be extremely pricey and very poorly, very poor coverage. So in a way, a growth in residual insurance markets is bad news for insurance availability in those high friction states. So I'm going to skip the related literature unless there are any questions afterwards, and instead move on to the baseline model that we started thinking of. So when we talk about standard insurance pricing model, insurance prices depend on three key inputs: demand elasticity, marginal cost, and financing frictions. Now, suppose that there is a big climate disaster that can lead to a shift in the loss distribution, which can affect prices through each of those three channels. For example, marginal costs can increase because insurers update their beliefs about how frequent and severe the loss going forward will be. And this is exactly what is going on right now in the case of California, which experienced multiple bouts of wildfires. Similarly, households can also update their beliefs, increasing their propensity to buy insurance, pushing up demand and thus price. Finally, after a big climate disaster, insurers usually have to pay out big losses. They have to pay out big basically losses for them. It can increase the financing frictions for them, thus driving up the price. So in our major analysis, we study how responsive are prices to losses. Basically, in the pricing model I just presented, the prices adjust immediately whenever we have a shift in each of those three inputs. And in theory, that's not a bad assumption, since homeowner contracts have relatively short maturities of 1 to 3 years. So in theory, insurers can reprice as frequently as they want to. However, we provide evidence that regulatory frictions in practice can be really restricted. So therefore, insurers may be unable to increase prices as much or as often as they would like to. So let me tell you a little bit more about what those rate-setting frictions look like in practice. There is a long history of regulating rates in homeowner insurance. And the reason why they exist is because regulators would like to avoid excessive rates and ensure affordable insurance for their constituents. Moreover, homeowner insurance is mandatory to have a mortgage plan, so having excessive rates can be especially a big problem for their consumers. So how does it work in practice? Every time a firm wants to change its prices, it has to file a request with the local state regulators. This can be potentially quite long and onerous process. And basically every filing has to provide detailed explanation of why a rate change is requested. And then once they review these requests, regulators choose whether to deny or approve, and to what extent to approve the rate change requested. Basically, we do see heterogeneity in terms of how onerous this process can be, both in terms of the probability with which approvals are granted, the extent to which they are granted, execution time, etc., and both in terms of the explicit rules as they are on paper. So let me provide you an example of a major US insurer, Allstate, and how it dealt with its rate changes in 2 states, one strict, Oklahoma, and one less strict in a second, Illinois. So here is a newspaper article saying that in Oklahoma, Allstate increased its homeowner insurance by 30%. However, originally they were hoping to increase their rates by close to 50%. However, regulators are not likely to approve such an increase, so they pushed it down. Interestingly, at the end, the article talks about how Allstate has a goal of making 5% underwriting profit each year, and not only have they failed to meet this goal, but in fact, for the last 5 out of the 6 years, Allstate had lost money on homeowner underwriting. So how does that, how is that sustainable? The second example will provide a little bit light on that. Basically, we're talking here about Illinois, which is a less strict state. And all states recently increased their rates by 8%. Because the detailed filings they have to file are not so detailed in Illinois, we don't know what exactly prompted that, but the newspaper article goes on and speculates that it probably has to do with the losses all states experienced in California's wildfires. So in a nutshell, we have a situation in which the Illinois homeowners rates go up because California experiencing wildfire. And for those of you who don't live in America, California and Illinois are very far apart and they have very different climate profile. So what do the rate changes look like? Basically, our rate change will be our proxy for rate shifting behavior. They come from rate change filings for all insurers in almost every state between 2009 and 2019. This is a novel data, and from it, we are able to extract, so basically, all I wanted to say is that from rate change requests, the two major variables have to do with what is the target rate change for each filing, which is the 48.6% in Oklahoma, and what is the rate change actually received, which is 30%. And Stein, if it will help, maybe I should stop my video.
It's fine again. It's fine again now. Let's try. Great. Let's try.
All right. So the main right-hand side variable has to do with the. I plot this on the histogram here, and you can see that basically there is a large wedge between target and received rate change for most filings. Basically, from the discounts, we aggregate across firms and years to compute the average friction experience for each state. When we do that, we basically focus on the largest insurers in state, which hold the large majority of market share anyways. And we did that mostly because the discount varies by firm size, and we wanted to stay consistent with our measure across states. But of course, we do check that our friction measure is robust to alternative definitions. More importantly, based on this friction, I split the states into 3 tercile: high friction, medium friction, and low friction. So our first task is to show that these frictions are indeed driven by rate changes, and they're actually binding for firms. We were initially worried that firms perhaps overstate their target. However, we find evidence against that. Specifically, in the table here, you can see that the lower the discount, which means the higher the friction, the greater the next year loss ratio, which means profitability drops. So basically, it seems that, it's not that firms are just overstating their targets. Further, we find that high friction states tend to have longer regulatory approval times, and also that high requests tend to take longer time to be approved by regulators. More interestingly, we find that insurers' filing behavior is less sensitive when it comes to losses if they are experienced in high friction states. So here we regress number of rate filings and how big the wedge between target and received is on what were the last year's losses experienced by each firm. You can see that large losses predict increase in number of rate filings only in low friction states. And you see that the gap between requested and targeted rates increases in high and medium friction states after losses. All this speaks to the fact that insurers' filing behavior is less sensitive in high friction states. So far we have established that we have for firms. And now the question is, how do firms work to overcome these frictions? We argue that there is a large-scale cross-subsidization across states, and basically that Illinois increases its rates when it experiences losses in California. So how do we test for that? The specification we use is the following. The left-hand side variable is the number of rate filings of an insurer in a given year, in a given state. And there are two variables of interest. One is own state loss, which is basically how much did Illinois lose in Illinois itself the previous year. And the main variable of interest here is other state losses, which is the lagged losses experienced in all states which are not the filing states. So this is where California would be reflected. Now, a positive gamma will imply that there is cross-subsidization, but in order to show that this cross-subsidization comes from rate regulation frictions, we proceed in two steps. First, we split the filing states by friction and we rerun the regression to see which states are most sensitive to out-of-state losses. Our prediction is that in low friction states, firms will be most sensitive to out-of-state losses. Second, we split other state losses into other state losses coming from high, medium, and low frictions in order to see whether firms are more sensitive to other state losses coming from a certain type of state. And our hypothesis is that they will be most sensitive to losses coming from high friction states. So when the out-of-state losses come from California, they will try to increase their rates in Illinois, but they wouldn't do it if other equally lax states is experiencing out-of-state losses because they already can adjust the price there. So this is exactly what we find. This is our results for splitting filing state S by friction. Here are the results for number of rate filings. And our main variable is other state losses here on the second row. In columns 2, 3, and 4, we split the filing states being high, medium, or low friction. And 5 just basically summarizes columns 2 through 5 with indicating variables. But what we can see is that other state losses are most predictive of number of rate filings increasing in low friction states. So in low friction states, insurers request more rate changes after out-of-state losses. Basically, the same result holds if we look at the size of the rate change requested and received. You can see that again, the less friction in the state, the more sensitive they are to rate change received. Here are the results from splitting the out-of-state losses by the type of state they come from. Here we have the number of rate filings and the rate change received. And we only focus on state frictions, on those filing states which have low state frictions. Why? Because those are the states which are, to start with, the most sensitive to out-of-state losses. You can see that, as predicted, the behavior is most sensitive to losses coming from high friction states. And to give you a sense of economic significance, after a large increase in out-of-state losses, the average insurer increases rates by 36% and the number of filings by 13%. So this is a big shift in regulatory filing behavior. So our next step is to show that indeed this cross-subsidization, has any real effect, right? To do so, we look at how prices change over time. We construct the cumulative price index for both strict states in blue and for the other states in red. You can see that over the last 10 years, aggregate insurance prices grew by 5% slower in high friction states relative to low and medium friction states. This is surprising because we do document that these high friction states actually have higher exposure to climate risk. And based on that, we do expect that they will increase faster, not slower. So here on the figure, you can see the friction level of each state. And here we see the climate losses per capita over the same period. You can see that basically in higher friction states, we have higher climate losses per capita indeed. So what does it all mean? It means that over time, we have decoupling of insurance prices from the underlying climate risk. We explicitly try to show that in the graph here, with again the x-axis being friction and the y-axis being how much does the price grow in each state relative to its long-run growth in climate losses. The negative slope here we see means that high friction states have low price growth relative to the growth in losses. So over time, prices get disjoint from historical loss estimates. So what does it all mean for the consumer? First, we find that, another strategy in which firms, employ to go around the, high friction states is to just exit the state. So here we try to predict whether after experiencing losses, a firm exits. And here you see that basically this is true only in high friction states. Also, the unconditional number of exits is quite low to start with. Also, we notice that this result is mostly driven from smaller insurers. This makes sense because in our analysis, we do show that the larger the insurers, the more they cross-subsidize. So it does seem that basically these smaller insurers have to adapt on a different margin. For the consumer, that means potential worsening of availability of insurance. So here we plot how much friction each state has and what is the change in residual markets. So what is residual markets? Basically, states set up these markets to help homeowners who cannot purchase insurance in the normal private market. These residual market policies tend to have really low coverage when it comes to insured risk. So in a way, the larger the residual market, the worse the availability of insurance. We can definitely see that high friction states have larger growth of residual market premium over the last 10 years. So that means worsening availability in those high friction states. So I definitely don't have time for the robustness checks, but let me summarize. Basically, in this study, we look at the prevalence of rate setting frictions for homeowner insurance markets, and we construct a new measure of how strict each state is and how binding these frictions are for firms. We find that as a result of these frictions, firms engage in mispricing and cross-subsidization of their homeowner products across states, which results in distortion in both the insurance price and availability for consumers. As our next steps, we hope to collect more granular level data, which is not at the state, but at the lower level, suppose the zip code level. And we also hope to assess welfare implications for homeowners. I apologize for my poor internet connection. I don't know what's up with it tonight. And I'm looking forward to your questions and comments. And thank you so much for your attention.
Thank you, Anna Maria. So if you could unshare, our discussant is Shan from New York University.
Okay, thank you so much for having me to discuss this great paper. Let me get started. So just to give you a quick overview, what does this paper do? First, this paper proposes this measure of regulatory frictions in home insurance rate setting. And this paper also finds that in states where there's more regulatory frictions, insurers tend to adjust rates less frequently and by less after their losses in that state. And they also find this really cool results that insurers cross-subsidize insurance rates across states in order to overcome this rate setting frictions imposed by some high friction states. And they also find that rates are disconnected from underlying risk, and they argue that this is not that great of a phenomenon, and the rates are growing faster in states with low frictions. So I find this topic super, super important. Of course, I'm kind of biased. Actually, my colleagues Viral Acharya and Johanna Strobel and I have been looking at the exact same set of data, and we were actually we were struggling with all these frictions imposed by regulators, thinking, okay, how can we get around it? But we find these authors very, very smart in actually studying these frictions themselves, which are actually very, very important topics. And overall, I think this is a great paper. I am totally in love with it, but of course, I'm forced to play the devil's advocate. So here I go. And first of all, the authors proposed this measure called discount, and that is, they argue this should be negatively correlated with regulatory frictions. So if an insurance company asks for a target rate change and the regulators only give them a small rate change approval, then this discount is small and the frictions are high. So first of all, I am really curious to I'm really curious about the source of the variation in this variable. Is it at the state level, or is a lot of the variation actually coming from the insurers? And given how insurers distribute differently across states, and we see a large variation across states, or this is more from like a insurer state peer effect. So to figure out the variation can also help address the following question. One concern I had, and the authors, of course, were also aware of, is that insurers could strategically choose this rate that they request from regulators. So one potential problem is that there could be equilibrium that exists maybe within a state or maybe within state insurer peers, where insurers ask for larger rate increases all the time, and the regulators know that, and in equilibrium, they just heavily discount their request. So let me just give you an example, a silly analogy. I know somebody on our panel has two wonderful sons, and one is older, very sophisticated, and let's say both of them are going out for the weekend. The older, more sophisticated son says, I'm going to see my friends and I want $50. And the parents know the older son, he probably only really need $20. So they say, okay, here's just $20 for you, have a good time. And the younger son comes along, he's very innocent, and he just asks for $20 to begin with, and the parents give them $20. So it will seem like the parents have, more friction, or they impose more discount on the older son. But this is a result of this equilibrium game that they are playing. And the authors did something really smart. So they use this discount and look at how it's correlated with insurers' profitability. And they find that if this discount is low, so if the frictions are actually high, the insurers actually do perform worse than next year. However, I find this exercise really smart because this is a question that I was struggling with myself. However, one small problem is that the insurers actually manipulate their reported losses. So this is documented by quite a few papers, including my job market paper, which is forthcoming on the JF. And there's also one paper that specifically documented that insurers manipulated their reported losses to obtain higher rate increases. So going back to my silly analogy, so this older son comes back to parents, and parents say, hey, did you have a good time? So in order to justify future requests of pocket money, the son would say, well, not that great of a time because you would only give me $20. So this is kind of similar. If the insurer wants to say, well, that rate increase was not adequate, so I'm going to manipulate my losses to say, well, I didn't do well because you would not let me increase my rate enough. So of course, the authors are aware of this, and I think they also provided a lot of other auxiliary pieces of evidence, and I totally agree. It's very hard to put all of those pieces of evidence together to say this does not really measure regulatory friction. But I do still encourage the authors to at least recognize this issue and also explore the source of variation. Okay, so next I want to discuss this key result from the paper where the authors find that following losses, insurers in high friction states are less likely to file rate changes. So they file fewer rate changes filings, and they also receive lower approval rate changes relative to how much they ask for. So the discount is larger. So how do we interpret this result? The first question that comes to my mind is, do realized losses really reflect expected future losses or the underlying risks? So in the perfect world, what we think should happen to insurance rates is that insurers should ask for rate increase when they think the future expected losses will go up, right? However, these reported losses, it's hard to, I would appreciate it if the authors provide more justification. Insurers do have a lot of data on climate, and here I think the underlying tone I gather from the authors is that when insurers suffer losses, they are updating their understanding about the climate. That could very well be true, but I think it would be very helpful if the authors actually show some of this. And one of the suggestions from earlier this evening was to look at, for example, catastrophe bonds and those more of a market measure of riskiness, and see whether these reported losses are actually correlated with those other measures of risk perception. And another concern is that, could this be some of the differences across the different states? Maybe in some states where they happen to have high frictions, the realized losses do not reflect future expected losses very well. So the regulator said, yeah, you suffered losses this year, too bad, but it doesn't mean that next year you're going to suffer large losses. So we're not going to allow you to increase your rate too much. Okay, so there could be other differences across states with different levels of friction. So one difference could be, again, about expected losses, but slightly different. So some states, maybe these high friction states, actually allow insurers to use projected future losses to justify rate changes. So this is, I forgot which states exactly do this, but some states forbid it, some states allow it. So if I'm a state with high friction and I already allow insurers to use projected losses, then when insurers actually suffer realized losses, they may not need to update according to the realized losses, because they would already have updated their rates according to their projected losses in other years, when their projected losses are actually changing. And another difference could be, well, the existing markups could be different across states. In some high friction states, insurance markups may already be high on average, because the authors actually take out the insurer fixed effects and other fixed effects. So it could be regulators say, well, yeah, you suffer losses this year. However, you're already charging a lot. So you're already earning a very healthy profit. I'm not going to allow you to increase your rates more. And of course, the distribution of losses could also be different across these different states. And these Y variables are bounded at low, at zero, at below. So other questions I have about this result is that the authors say, well, to interpret this result, maybe rate filing is more costly. Then why would insurers bother if the payoff is very small in high friction states? That's why they file fewer such rate filings. So one suggestion I have is to look at the actual requested rate change. So the idea is that if the insurers actually need a rate increase and they know regulators are likely to discount the request, they would actually ask for a larger rate increase in each of these requests. And I think more importantly, this paper tries to draw this large conclusion about the welfare, not welfare, but along those lines. They're trying to say, well, so for high friction states, these blue lines, the price has increased less compared to those low friction states. And these price relative to climate loss increase has been lower for these low friction states. However, it's a little bit puzzling to me. Why do we care about the price growth? What if high friction states started out just with higher markups? And I think another challenge in this literature is also that it's very hard to measure the expected loss or the underlying risk. So to look at, what happened in the past to say, this price is fair, or this price is not fair, or this price is too much compared to other price, it's very hard to say because we don't really observe what insurers' expected losses are. And another small comment is that these losses you're measuring could also be largely absorbed by the government flood insurance. And one suggestion I have is one thing we could do is to just look at insurance profitability. If insurers are actually losing money year after year, then we know it's probably not going to be sustainable. That's more straightforward of a measure. So I have a small comment about how you can measure exit. And as I was listening to your presentation, I know you added this result about residual market. So one counter intuition I have is that if in the high friction states, there's more rate suppression, that should actually help customers to obtain coverage in the commercial market. So I know I can also see why you predicted your result, but I would also encourage you to discuss this prediction. So overall, I think this paper study is a very, very important topic, and explores a very, very interesting idea, and the results are fascinating. I'm definitely in love with this paper, and I congratulate the authors on such a great paper. Thanks.
Thank you, Shan, for a great discussion. Why don't we start with giving the authors a couple of minutes to respond, and then we'll take some questions.
Thank you so much, Shan. This was a great discussion. Please send us the slides because this had a lot of great ideas for us. I just want to address several points you made. One has to do with the source of, of the variation in discount. Is it states? Is it insurers? So I just want to point out that we think it's probably a combination of both. We do find that the larger the insurer, the more the wedge grows between targets and rate change actually received. But we definitely see that for the most part, no matter which way we specify, there's a lot of stickiness in terms of our classification. So it does seem like the strict states very rarely get classified as the least strict states and vice versa. So in a way, it is a combination of both. And that's why we limit to the top 20 insurers as well to make sure that we compare apples to apples. So I think you're making a wonderful point about the expected losses versus realized losses. Basically, it came to our attention recently, that there's two variables that are being reported. In our analysis, basically, we only use actually realized losses, which, of course, we discussed that, as you discussed, it's not a perfect proxy. But yes, I think that both of us would agree that what we have right now as actual climate change proxies based on these historical realized losses is a poor man's version of actually updated expectations. We're currently in the process of, getting a little bit better at understanding where did expectations of insurers themselves shifted the most in the period, and trying to see how the insurers acted in those states, right? In those places. We definitely may need more granular data though. So for now, it's not feasible. Hopefully with the granular data, it will be.
Okay, let's take one question from the chat. So there's a question from Lou asking, why do we see cross-subsidization kind of not only across states, but why not across business lines? So for example, why not cross-subsidize with car insurance or other lines of business?
So we definitely are interested in looking into that as well. Currently, we're collecting the price increases of auto insurance and seeing if those are responsive. So it's, you know, it's something on our mind too.
So I had a couple of questions as well. So one is, are there any ways of getting around these rate setting rules, for example, through contracting, right? So can the insurer, for example, build in a schedule of annual increases that will be, automatic, so that they don't have to ask approval for them? So that's one question. The second question I had is about competitive dynamics, right? So there's got to be some insurers, you would think, that have less exposure to California, in your example, who can afford to keep premiums low in Illinois as a result of that. So, how come that competition does not stop, these rate increases in Illinois? And then my last question is about, the endogeneity of these high, medium, and low frictions. Like if my insurance goes up because, I'm in a low friction state, why doesn't my regulator start clamping down on all these rate increases, right? Isn't there like a political process that is going to force these low friction states to become high friction states to avoid these rate increases?
Great. So let me start with the first question, which has to do with basically, does the contract change, right? This is definitely something we hope to be able to address more head-on with granular data. But what we have done so far is, okay, we talk about contracts and contracts shifting. That can mean a few things. It can mean people like insurers covering fewer risk. So we do look into that. Basically, three types of contract that dominate the market, and we should call them low, medium, and high. For those who are really in the weeds, these are HO2. So basically, the medium type of coverage stays the same, and we don't see shift towards the lower coverage. We see a small shift towards the higher coverage, but it's fairly minor. So in a way, we do think that the coverage stays for the most part, at least in the aggregate, more constant. So this is not the margin on which they adjust. Alternatively, less coverage may mean you used to insure your house for $200,000. Now you can't afford that, so you afford it for only $150,000. So again, no evidence for switches into that lower category or just switches in general. So we don't think that is what is going on. The last thing that we haven't been able to really check is perhaps if I'm a savvy insurer, I live in North Carolina right now, I stop insuring the coast, which is extremely prone to hurricanes, and focus on the inland side, right? Nothing in our data so far can go there, but we do hope with granular data we can address some of that. Your second question had to do with competitive dynamics and why doesn't competition eat that away? Basically, our understanding is that these are fairly concentrated markets, right? They're, the top 20 firms control over 75% of the market in the average state. So we don't think that it is as competitive as, I think that people think that it's super competitive because they see a bunch of brokerages making commercials, but it's much less competitive than people think. And then when it comes to the endogeneity of high, medium, and low friction states, yes, it is something that worries us. I think that the processes of people switching into high, medium, and low friction states, like states switching into high, medium, and low friction states, may be happening, but perhaps we think it will be on a much longer scale because we have only 10 years worth of data. And I think that part of it has to do with low friction states have also lower climate risk. So it's not so high on people's attention to pester the insurance commissioner.
Great, thank you, Anna Maria.